Well, good morning, everyone, and welcome to this GJM webinar. I am Susan Ross Wells. I'm the marketing manager here at GJM, and we're here to talk about the Employee Retention Credit, or ERC, and your business. Been a lot of confusion in recent days from businesses trying to figure out with these new parameters if ERC is something that they can take advantage of and should take advantage of. We've been getting a lot of questions from our clients as well. So what we decided to do was pull together some of our experts who are answering these questions to hopefully help to educate you to see if indeed it is right for your business. So quickly, I'm going to mention we will be getting the recording of this webinar out to you afterward, as well as the slides. We're also going to be posting it on our website at gjmltd.com. Just go to our COVID Resource Center and you'll find the recording there. Also, we're going to do a panel discussion with our experts, and then we're going to do this Q&A session. And our partner Greg Taylor is going to lead that. But here's where you can answer, I should say, pose your questions, whether you're mobile or desktop today. So please enter your questions. Our experts are telling me that, you know, a lot of this can be very individual for a business. So that you may have some very specific questions, so feel free to enter those. Just want to introduce you to who is going to be sharing today. If you are not familiar with our GJM experts, though I know many of you are, Charlie Hyde, one of our tax partners, is going to be on our panel this morning. He has a 30+ year career and has served clients across industries, including certainly manufacturing, but wholesale distribution, retail, construction, and other industries. Bob Bobeck is an assurance and consulting partner and has over 35 years of experience in public accounting, works with privately owned companies across multiple industries, concentration in construction and manufacturing. You've probably seen Bob, Charlie, and Greg on some other webinars we've been holding in recent weeks. And Greg Taylor is our assurance and consulting partner, specializing in assisting clients with developing strategic alternatives, future plans, financial forecasts, systems re-engineering projects, quality of earnings, due diligence projects associated with merger and acquisition transactions. So you've got people who know what they're talking about this morning on this panel. So with that, I'm going to hand it over to Bob Bobeck, who's going to start things off for us this morning. Bob?
Thank you, Susan. Turn my camera on. There I am. And okay, so a bit of history. So good morning, everyone. Thank you for joining us this morning. You know, just recently on March 12, 2021, there was a seventh stimulus bill passed along this route of providing stimulus to our economy due to the pandemic. And this all started back in March of last year when most of the states, including Governor DeWine, was shutting down the state of Ohio due to the pandemic. And so back then, in December 27th, not December 27th, I'm sorry, go back a little farther, March of 27th, there was the CARES Act that was passed. And the CARES Act had a choice to be made, to do a PPP loan or this employee retention credit. And so that was provided for in the CARES Act, but you had to choose one or the other. And then in the final law signed by President Trump, a stimulus act, the Consolidated Appropriation Act of 2021, which was signed into law on December 27, 2021, they now allow you to use both programs. So there's no more limitation that if you use the PPP, you cannot use the Employee Retention Credit, which we're going to refer to as the ERC. And so you now can go back and look at your 2020 results and see if you qualify for this Employee Retention Credit. And so when we look at the two main programs that were provided for in the CARES Act, the PPP program, Paycheck Protection Program, and this Employee Retention Credit, they follow different sets of rules. And so that's why I want to be very clear throughout this presentation. So under the PPP, the Paycheck Protection Program, that is a program that was set up by the federal government and is administered by the SBA. And the SBA is primarily a provider of loans to small businesses. And so that program starts as a loan, where you fill out a loan application, and then the SBA reviews it and approves your loan. And then you follow the requirements of that program, and then you fill out a second application or application for forgiveness, which then is also then reviewed by the SBA. And so once you follow that process and the SBA approves your forgiveness application, the loan is forgiven. So that's an application process. Now, the employee retention credit is following the rules and requirements of the Internal Revenue Code. So this will be administered by the IRS, oversight by the IRS. And so this works like any other tax credit in the current tax law. So what happens is you have to do your research and determine if you qualify for this credit, and you have substantial reasons to believe you do qualify for this credit. If you do qualify for the credit, you would then ask for that credit on your 941s. So there's a line where you actually request the use of this credit, or apply for this credit, not apply, but actually file a tax return where you're saying you're eligible for this credit. And then what happens is you get it. You get the credit, and it reduces your tax liability on your 941. And so then what the oversight there's no application here. The oversight is with anything else with the IRS, they have up to 3 years after you file a tax form claiming your credit. So this would be the 941. You have up to 3 years after you make that filing for them to come in and audit that credit if they deem they need to audit it. And then you have to provide your substantial proof of why you claim that credit. And usually, if you have substantial proof, they approve it and you still get to retain the credit. So it's more of an audit cycle in the approval if this credit will be denied. So again, it's a whole different facts and circumstances. Okay. So when they first changed this, where you can start applying the credit for both the ERC and the PPP, they initially only made that available through June 30th of 2021, the first 2 quarters. And then in green down below, and like I said, on March 12th, 2021, the American Rescue Plan was enacted, and that extended this credit through the end of December 31st, 2021. So now you have available to claim this credit for both 2020, if you have not already done so, and 2021, as you complete your quarterly 941 filings. And let's say that you do qualify for the credit in 2020. We'll be talking about this shortly. You would go back and amend your tax returns, your 941s, to claim the credit. Okay, so this credit is allowed against FICA taxes that's claimed on the organization's Form 941. And you could amend your 2020 941 to now claim these credits. Now, if you also have a PPP loan and you're using both programs, you could only use the wages for one. So you first, especially if you're going back to 2020, you're going to have to go back and see what wages you used for the forgiveness, if you've submitted your forgiveness application already. And then the available wages beyond that are available for the ERC. We're finding out, talking to a lot of our clients and friends and everything, that they have enough wages to participate in both programs back in 2020. So this is something you should definitely look at. But you have up to 3 years now, because you're going to be probably amending your 941s. So there's no real rush to do this, but you have up to 3 years from the date you originally filed that 941 to go back and amend it and claim this 941. And technically, the order is you're supposed to use your ERC first to use up the wages, and then the rest for the PPP loan forgiveness. But now it's after the fact. I know a lot of companies have already submitted a forgiveness application. And let's say on that forgiveness application, their loan was $1 million, but they put $2 million of wages on there. Those additional wages beyond the forgiveness amount are available for this ERC. So you only have to use up the $1 million of wages, even though you put $2 million on your application. And the additional $1 million is also available now for this ERC credit. So there are two sets of rules, one for the credit in 2020 and one for the credit in 2021. And there's an eligibility rule and an FTE rule. We're going to talk about both. So the 2020 rules for eligibility, the mathematical one, or the one I think that's more black and white and simple, is a 50% reduction in gross receipts, which we're going to go over shortly what gross receipts are, but it's primarily your revenue, in the first, second, third, or fourth quarter of 2020 as compared to the same quarter in 2019. So that's a simple one. And so that's simple mathematical calculation. You add up your gross receipts in those 2 quarters, calculate the difference, and see if you had a 50% reduction. Now, let's say you do not meet that requirement. There is also an ability to be eligible for those businesses that were closed or partially closed during the pandemic due to a government order. And there are lots and lots and lots of government orders out there. There are government orders being made at the federal level, at the state level, and at the city and county levels. So you really got to think hard about all the government orders that were mandated in your community and how that impacted your business. And for the partially closed, it's a 10% rule. So you had to be impacted by at least a 10% reduction in revenue or in labor hours for a quarter in 2020 as compared to a quarter in 2019. And so again, there's a substantial, you can't be like you just went down by 1%, but it has to be at least 10% to claim this partial closure. But we'll find out there's a lot of companies that maybe fall under this provision here. And again, it's going to be case by case. And so, we work with a lot of contractors. And so as you can imagine, most contractors' primary workplace is not at their corporate headquarters, it's at job sites. And sometimes those job sites are spread throughout various states. And so maybe they had in the second quarter of 2020, a state they were working in that said they cannot work in that state. And they were disrupted or shut down on that job. And if they meet that 10% test, they do then qualify for this ERC. So again, it's kind of gray, and it's got to be case by case. But everyone, if you're not meeting that 50% test, and then should probably divert back to that closed or partially closed and start examining all government orders and seeing if you might qualify under that test. Now again, the credit is 50% of the qualifying wages and health benefits paid in a quarter. And the maximum credit for 2020 per employee for the whole year is $5,000. So again, that's the maximum. So you get maximum $10,000 eligible wages for the whole year of 2020 for each quarter that you qualify. And the maximum credit you're going to get is $5,000. So it's not as big as we're going to see in 2021, but it is something that should be examined. I mean, we're looking at clients right now where they qualify. And I know, I think we're getting a little used to these big stimulus dollars because the PPP loans, especially in 2020, were much larger. But let's say you're eligible for a $60,000 credit. I mean, that's available to you. And you should be looking at it and taking advantage of it. Now, there's this employee FTE rule, and there's one rule for 2020 and one rule for 2021. So first, you qualify for the credit. And so then you have the FTE requirements. So if you have less than 100 employees, you get to use the credit for every employee. If you have greater than 100 employees, then you only get to use the credit for wages paid to people that were not working. And that's kind of gray again. It's kind of gray. So again, we're seeing companies in the automotive industry that has substantial reduction in their revenue in the second quarter. We're seeing 80, 70% reduction, but they have greater than 100 employees. And so in this scenario, let's say their management team all is making the same amount of money they did in the first quarter as the second quarter. And those are primarily the wages you're looking at. And you can demonstrate that they were working 60% less because their workload was just down. Maybe they were managing 3 shifts in the first quarter, now only managing 1 shift in the second quarter. So a portion of those wages should be eligible to claim this credit. So let's say it's 60% less work that they were doing. So 60% of the wages are now free and available for this credit. So again, it's going to be case by case. There's no black and white here. And again, we encourage everyone to meet with their controllers, their CFOs, and their people that are supporting their business and examine this closely. Now, 2021, the rules loosened up quite a bit. So again, we still have this closed or partially closed availability be eligible, but now it's a 20% reduction in gross receipts in any quarter of 2021 as compared to the same quarter in 2019. So again, now the threshold is 20% versus 50%. So again, we're always recommending doing the math first, see if you meet that. And if not, then look at the closed or partially closed due to government order opportunity. And this credit is much larger. So it's 10,000 of eligible wages and health benefits per quarter times 70% instead of 50% as in 2020. So the maximum credit for 2021 is 7,000 per quarter. And if you're fortunate enough to be eligible for all 4 quarters, that can add up to 28,000 per employee. So again, much more opportunity in 2021. And now they've moved this 100 FTE rule up to 500 employees. So anyone under 500 employees can do it for all employees as long as they meet the eligibility requirements up above. And those that are over 500 employees are still eligible, but now they have to go back, and the only wages that are eligible are those that you were paying to employees not to perform their normal duties, not to work. So again, this is kind of gray, and again, it's got to be case by case. But again, that eligibility is there. So what is gross receipts? And so we have a lot of not-for-profits also participating in this call because they are also eligible to claim these credits. So here is your definition of gross receipts for for-profits. It's your sales, less returns and allowances, plus investment income, interest, dividends, rents you're collecting, royalties you may be collecting, any annuity payments you're collecting. And the PPP loan forgiveness is considered a gross receipt in the quarter you actually get forgiveness granted by the SBA. So this will follow the tax reporting. So that would be in the quarter you actually get your forgiveness. And the last thing here is if you're selling any assets, investments, assets, any assets, it is the net gain on these as defined as the proceeds from the sale of assets minus your adjusted basis in these assets sold. So again, those also have to be included, but you do that for both the 19 year and either 2020 or 2021, which each year you're doing the test on. And then for not-for-profits, this definition is very similar, but it expands on to include, again, total sales, less return allowances, plus investment income, plus interest, plus dividends, plus rents, plus royalties. And then here's the additional ones for not-for-profits, any contributions or gifts, grants, member dues. And again, we're back to the annuities, PPP loan forgiveness. In the quarter, you actually get the forgiveness granted. The proceeds from the sale of any assets plus adjusted basis in those assets. So again, very similar, but just expanded. A few more line items are included for not-for-profits. So again, when you look at this is going to follow all the Internal Revenue Code. Okay, and so again, under Internal Revenue Code, you cannot deduct the wages equal to the amount of the credit you earned. So for each dollar amount of credit you earn, you lose a tax deduction for those wages. Okay, again, so this makes this credit for those taxpayers that are taxable. Not-for-profits, of course, this would not apply. But for the for-profits, make this credit like taxable income, the amount of the credit. So there's a tax impact to this credit where there wasn't one with the PPP loans. The forgiveness or PPP loans are not taxable. And then again, in the IRS, there's aggregation rules for gross receipts and FTEs that you must follow. Okay, so when you're doing these tests, you must identify all the members of your group, your aggregate group. And those are defined below as parent subs, brother, sister controlled companies, corporations, and similar rules for partnerships and trust. And it's generally based on a common ownership of greater than 50%. You need to combine all the gross receipts to do that 50 or 20% test, and for the FTE test, if you're for under 100 in 2020 or under 500 in 2021. So again, you got to aggregate. So Charlie, you want to take it from here?
Thank you, Bob. I sure will. So we're gonna, now that Bob's kind of walked us through the rules, let's just take some very high level examples of how this works. So here in front of us, I've got an example for you. So let's assume that this is a company that has been impacted by a governmental order that is not allowing them to work at their full capacity. So because of that, they've got some employees. One employee continues to work. One employee is currently not working. And they're getting 60% of their normal wages. So in this case, well, let's also throw in and just assume this is somebody who's, you know, for 2020 is over the 100 full-time employees. So they are only able to take the wages that are subject to that, you know, paying somebody to not work at their full capacity. And that's what we've got here in this example with 60% of the wages. You also get to include your health insurance. That's important to realize is that you're continuing, if you're paying for employees' health insurance while they're not working at full-time capacity, you still get to pick that up and include that in the $10,000 cap for 2020. So in this case, we come over to our qualified wages by employee. We look at the $10,000 cap. Deb was over the 10, so she's capped at 10. Chris was under 10, so we take the actual for Chris. We compute our credit at 50%. And then what Bob was referring to just a few minutes ago, that when you claim this credit, it's going to impact your income tax return. The credit is claimed on your payroll tax return, but your income tax return is going to be impacted. And it's impacted to the extent of up to your credit amount. You cannot deduct that amount of wages. So if you remember in our example, we had 18,400 of wages. However, our credit's 9,200. So we are limited to, we can't take a deduction on our wages and that return up to that 9,200. The tax effect of that deduction lost is $2,760. As you will still see from a company cash flow standpoint, I was still better off claiming the credit, losing the partial deduction in my income tax, and I net more cash for the company. And we just think that's important to realize. The other thing I'll say about 2020 is if you have already filed your business income tax returns for 2020, don't disregard this credit. It means let's look at it. If you can claim it, let's claim it, and that will require you to amend your return. If you haven't filed yet and you've extended, obviously you want to look at this opportunity before you finalize your income tax return. All right, let's move on to another example. So here's a 2021, and let's in this one say a company that didn't qualify for the 100 full-time employees in 2020, but they raised that threshold now to 500 employees. So they're now coming in under the 500, and we'll keep this simple and say that in 2021, in the first quarter, they looked at their gross receipts for 2021 compared to that same quarter in 2019, and they had greater than a 20% drop in gross receipts. So they now get to pick up all the wages. So in this case, Chris and Deb, you've got their quarter one wages. We've got the health insurance that's being paid for them. And then we come over and we say, okay, 10,000 is our limit per quarter per employee. So Deb is over the 10, so we're capped at 10 for her. Chris is under the 10, so we use actual. We get a 70% credit this time. So it's 13,265 on the credit. Then we come down, again, for 2021 tax return, income tax return, we will not be able to deduct up to the amount of the credit, and the tax effect of that is 3,980. I still netted out cash flow after tax impact of 9,285. So as you can see from a cash flow perspective, this is a very powerful tool that needs to be looked at. Let's look at a few other items related to this. So let's remember, as Bob had mentioned, with the recent stimulus bill, the American Rescue Plan, they've extended this credit out to the end of the year. It originally was going to expire at the end of the second quarter of 2021. So all of 2021 is now in play, and that's important. It's a refundable credit that you're going to claim, against Social Security tax. You're going to do that on a 941. And 941X can be filed up to 3 years. I've had one client already who has filed, their payroll company filed the 941Xs for second and third quarter of 2020. And again, they're just waiting for the refund to come from the IRS. So any credit earned in the first quarter of 2020 from the time the CARES Act passed to the end of March, so that would be in that first quarter. Just want to point out, there's a line on the second quarter 941 where you claim that for that 2-week period on your second quarter 941. You wouldn't do a first quarter 941. I think that's important to realize. Again, to do all this, you want to amend your 941s, and that's easy. Once the calculations are done, you just get with your payroll company to help with the processing of those 941Xs. And if you're doing it yourself, that's where you would want to work with your trusted advisor to make sure they're getting done correctly. All right, let's move on. So I just want to give some final thoughts on this credit. I'm still in discussions with clients. It always comes up, well, I didn't realize I could do the ERC because of I chose the payroll protection program. And again, a year ago at this time, those were the rules we were operating under. And then that changed at the end of 2020, and it opened this up to a whole new analysis of how do I maximize my PPP forgiveness. and get the max I can out of the ERC for 2020. And that can take some massaging to kind of make sure where we're at. If you filed for forgiveness, let's look at the periods before you got your PPP loan, because that's when your coverage period started. So any wages after March 13th through that date you didn't use for PPP. So we can take those. And then we look at what wages we can pull in. Did you use excess wages on your PPP loan forgiveness? If you did, guess what? We can pull that in. So there's a lot to do in understanding this for 2020 and 2021. Again, I can't emphasize this enough. You want to work with a trusted advisor who is really aware of these rules, especially when we're talking about you didn't qualify for the gross receipts, so you're going to have to go in under the government order. That's where you need to really work and build your case, and you build it now to be able to claim the credit when you have to go in as I was impacted due to a governmental order or a partial shutdown. And the other thing that's important right now, and I would get started on this, is you can imagine, as Bob had mentioned, there's lots of orders out there, both at the state level, city level, county level. You need to go out, you need to capture those orders while they're still out there and available on websites. I can tell you an exercise we had with some interns, they did that, and it's time consuming, but it's important to capture those orders that impacted you and get them saved right now before they disappear from that county's website or that city's website. And again, I want to encourage, we're here to help. If you have questions, please do not hesitate to call. We do have a group that is going to be focused in on this and is answering questions today, and we're happy to help. So with that, I think we're going to go back to a Q&A, and please, I encourage you to send in your questions, and we'll see if we can get those answered for you today.
Gentlemen, the first question I have is, one of the AICPA webinars that somebody had listened into said PPP forgiveness was not gross revenue for the reduction in revenue test. So their question is, which is that? Or is that in looking at the PPP eligibility? Can you guys comment on that, please?
Well, yeah, so it's very clear for PPP round 2 eligibility that it is not. Again, is the SBA rules for the PPP program. So now I'm going to divert to Charlie with the IRS.
Yep. So that's a great point. Different rules, and I think at this stage, I think everyone on this call would agree that we've all gotten used to rules changing on the fly, better clarification. So we're all used to living in that world, but when it comes to the gross receipts for the retention credit test, it's very clear that the forgiveness will impact your gross receipts for that test. And I would direct you to its code section 280C.
So a question related to that is, what happens in the situation where I have over 100 employees? If I'm using the grant method of recording the PPP forgiveness versus the loan method, is it so when's that impact for the ERC, Charlie, on the tax return in both those methods? Does it matter how to record that? Can you speak to that, Bob or Charlie?
Let me start again. So the grant method is the method for generally accepted accounting principles. It's for financial reporting. It's not for tax reporting. So again, that is the method you've selected to report this on your financial statements. Now I'll let Charlie talk about the tax returns.
So we have looked at it if it is included in your financial statements as forgiveness, as the grant method, and you as a management team have filed your application and you believe you will get forgiveness, we're treating that as tax exempt income in the year that you would have recognized it under the grant method in your financial statements. So that's when we pull it into the gross receipts.
Okay. Another question. Can we claim the 10% impact on our business due to the partial shutdown in 2020 and then claim gross receipt deduction of 20% or more for Q1 of 2021?
Yeah, I don't see it. What do you think,
I
Charlie?
don't see any issues. There's two separate years. Yep.
Two different set of roles. You can qualify under different roles each year.
Yep.
Would this $5,000 credit per quarter, would that cancel trade shows due to the government orders that resulted in lower sales counts? Would that apply for that reduction?
There's been a lot of discussion about that. Charlie, you want to take a stab at that? I know there's been a lot of.
Yeah, that's a gray area. The IRS, and I would encourage everybody, if you're not, to monitor the IRS. We are, and again, I say that because if you're a client of ours, we're monitoring for you. If you're not, I would encourage you to look at the IRS website. They are continuing to put out new guidance. So far, we have 2 notices out on the ERC giving better clarification. The last one came out last week, and that was 2021-23. I would encourage you to just watch that. These types of questions are being posed to the IRS. The concern I have on the trade show and the impact is, remember, a lot of trade shows could continue virtually. Yes, you weren't able to be there in person. You might say that, geez, I wasn't able to go to that trade show, so it had a direct reduction in my sales that was greater than a 10% impact. Again, you've got some good facts, but how is the IRS going to interpret that? And I would just encourage you, get those facts laid out and work with your advisor to really kind of say, are we comfortable with this? Can we support it? And then keep monitoring the IRS for any further guidance.
Yeah, and then so another thing is like when you go to those trade shows, are you coming back with purchase orders? Are you actively, effectively selling at those trade shows? And you demonstrate that you didn't go to it. So in 2019, you went to a trade show and you came back with $15 million in orders, and you didn't get them this year. You didn't go to a trade show. And that's more evidence that that trade show was necessary for you to have your stores.
And when we're building under that scenario of impacted by government, it's a facts and circumstance. You've got to gather your facts, get them listed out, and you do it now while it's still fresh in your head. You don't want to wait to capture that and get that story now, because the employees that were impacted obviously are with you still. 2 years out, when you decide that, hey, let's go after this credit, they may not be. So you want to jump on that right now and build that story.
Next question. If the credit is only refundable up to the amount of Social Security taxes owed or paid, what happens if Social Security tax is lower than the calculated credit?
So I'll address that one. If you, it's in the section when the ERC was put into the CARES Act. If there is an excess amount over your taxes, it becomes refundable. It's coming back to you.
And Charlie, a second part of that question, what if we did the FICA deferral for the 2 years? Does that impact the ERC? Would the IRS keep the credit to offset the FICA deferral?
Well, I can tell you the IRS has not addressed that. If I use a prior example of where the IRS has maybe done something like that, that had to do with the Code Section 965 that came in 2 years ago, where it was kind of repatriating foreign income. You calculated a tax and then they allowed you to defer that tax and pay it in over 8 years. The IRS, though, came out after the fact and said, if you have an overpayment on your return, we will take that overpayment and apply it against your deferral. So anything's possible. But no, if you've taken advantage of the deferral, you can still claim this credit and you would get a refund for the credit you've calculated. And if anything, you might say, hey, I've got the funds now to repay my deferral.
Yep, and the way I look at it, just listening to that question, is that when you deferred these FICA taxes, that was an interest-free loan. Now by getting this credit, it's forgiven. It's forgiven if it applied against that deferral. So again, you might not get the timing of it all the way up to 2022, but still, it's forgiven, better than paying it back.
And I will say, I'll just as an added one for that person who submitted that question, just be aware that on your 2020 tax return, that deferral, unless you've made a payment on that deferral, you can't deduct it. It's going to be a non-deductible payroll.
That's at least another interesting question. So if they do apply this, does that free up that deduction? Or does that happen in the following year?
Yeah, the following year, it happens in the year you pay it. There is a position that if you pay it by the extended due date of your return for 2020, you could still deduct it on the 2020 return.
Yeah, there might be some opportunity though if you're amending your 2020 941.
Yep.
Maybe freed up. It's an interesting question.
Here's the next question that we've heard quite a bit, but it's a good question. We only paid a few employees during the shutdown. However, we did pay insurance for all employees during the program or during the shutdown. Can we claim all of the health insurance paid even if there was no wages paid to an employee?
Yes, the answer to that is yes. You pick up their wages plus the amount of employer-funded health insurance. Correct.
Mm-hmm.
So Bob, early in the presentation about the forgiveness, and I think as an example, it was $1 million or something like this, so $1 million loan, but I submitted $2 million of payroll deduction. So he's able to, anyone's able to use that additional $1 million. What if I just used 100% payroll? Can I go back and amend to include the other expenses that are deductible?
Yeah.
Forgiveness as part, and then free up even more wages for the ERC credit.
So unfortunately, there is no provisions out there to amend a PPP forgiveness application. And furthermore, even if it's already been forgiven, to go back and amend it, I don't know if you would want to even try to do that if you already got your forgiveness letter. So unfortunately, that might not be available to you. However, you know that now for the the first quarter of 2021, if you have a PPP round 2, you should definitely look at the rules when you go to fill out your forgiveness application to minimize your payroll if you're eligible to use it for this ERC in 2021 and use up the other 40% side of the bucket. We all know they expanded what is available for that 40% beyond the first 3, which were utilities, rent, and interest. And then I now added 4 other new cases. The most interesting one is material necessary to operate your business under a purchase order. So it was really designed for restaurants to buy a lot of food product, okay? But it fits anyone. So, if you're a manufacturer buying a bunch of steel, it fit, potentially qualify here. So you can use up that 40% really quickly now. and have this, only 6% of the payroll being used for the PPP forgiveness.
So Bob, to add to that, we do suggest that obviously if you are eligible for PPP2, you're definitely eligible for the ERC
Yes.
credits. And our recommendation is to look at both and to maximize the forgiveness and the credits. And that's where, it's a mathematical formula. It's a facts and circumstances basis by client. But that's where a lot of calculations and advice needs to go in to try to maximize both of these.
Yeah, you got to play that out through this 2021 year here and just balance it. And your forgiveness application will not be due until 10 months after your end of your covered period, which would be probably at the end of this year or early next year. So again, you have time to balance it out to maximize this. The important thing is that if you have not got a PPP round 1 or round 2 loan and you're on the fence about doing it, I would recommend you strongly do it today. They are expecting the money to run out next week. So there has been an increased demand for those loans, and they're at the very end of that allocation of money for those programs.
This is a good question, and so this is related to the forgiveness of the PPP loan. Have we seen any of our clients that have gotten forgiveness of anything over 2 million?
No, we have not. And we've talked to a lot of banks, even the really large banks that have looked at their database throughout the whole country, and I keep on hearing no. Now, again, I'm not getting overly concerned about that. The SBA has been required to do a lot of programs beyond this PPP. So right now, today, they are starting a grant program for theaters, for shuttered operations program. It's available from Broadway to theaters. That grant program opens up today. And so they're going to get overwhelmed with those applications. Second of all, next week, the Restaurant Revitalization Fund opens up. That's a grant program for lost revenue available to restaurants. Huge opportunity for restaurants. That opens up next week. That's a grant program. They don't even have, I don't think, the application yet to get for that one. And that's going to be a grant program. And then finally, about loans over $2 million, the Association of General Contractors continues with a lawsuit challenging that questionnaire. And we're hearing indirectly from the banks that the SBA is waiting to hear the outcome of that lawsuit because they be allowed to use that $2 million questionnaire and go back to decide how they're going to look at loans over $2 million. So it's going to be a drawn out process, unfortunately. So.
Here's another question. I'm glad I participated in this. I didn't realize you can actually apply for both, because at one time I know that the ERC, you could not do both. So if I'm sitting today realizing I need to do that, what's the recommendations from Charlie and Bob of what I should do to start the process and look at both these, knowing that time's running out?
Yeah, again, you got 3 years, so there's time. Yep. And so there's two ways of looking at this. You probably want to look at 2021, the first quarter, to see if you qualify under those rules. And take that credit right now on your 941 if you do qualify before you file it at the end of April. And then I would recommend you go back and look at 2020. Those rules are a lot tighter. So there'll be a lot less eligibility, but the credit's a lot smaller. And like we're finding out, like you might not meet the FTE test, but then because you had substantial less production out of your employees, even though you're paying them, and the health insurance, you might still get the $5,000 credit, even though it's going to be only partially available. It could add up quickly to $5,000 still. So you can still get the full annual credit over maybe a couple quarters. Charlie, what would you suggest adding to that?
Bob, I don't know if I could add much to that. Greg, I just wanted clarification. Is this, was the question indicating that they were looking to apply for their first draw PPP in addition to the ERC?
No, well, I wasn't sure. I think it's more indicated to like PPP2 and walking through that. So it wasn't that clear.
Got it, got it. But again, the ERC with the Consolidated Appropriations Act is a huge tool in this pandemic to help businesses. And I would encourage you, whether you have the PPP, well, if you don't have the PPP, it's a no-brainer. But if you have the PPP, you absolutely need to be looking at maximizing both and working with your advisor on how do we best do that to get the forgiveness and maximize the credit.
I think one of the things, Charlie, when we started looking at it, I know in a couple of examples you and I have walked through with clients, is actually the credit can actually be more beneficial in dollars, even net of tax, than the PPP2 or even one was. And so that was one of the ones, especially now that the 4 quarters are being able to be eligible. Can you also speak to, there's something I've read where if you're eligible for Q1, does that automatically, are you automatically eligible for the subsequent period?
Oh, that's a great question. So under the gross receipts test, you would, if you met the gross receipts for Q1 of 2021, then you're going to get the trailing quarter. So that's Q2. If you don't meet the gross receipts and you're going in under the governmental order approach, that's a little different. You don't get that trailing quarter. You get it for the period that your business was impacted by that governmental order.
Another question regarding the PPP for round 2. Have they changed the requirements from a calendar quarter versus just a 3 months comparison to 2019? So still on a quarter basis, or can you use any 3 months on a comparable basis?
I'm pretty sure it's a calendar quarter, although I have heard some banks were accepting it on different 3 months. But again, everything I read, everything I see, it's a calendar quarter.
Here's another question. If government shut us down for only a couple of months, are we limited to use the wages during that period?
I think it's quarter by quarter, isn't it, Charlie? So let's say that was the second quarter. It was a couple of months to meet the requirement of, more than 10%, and yeah, you would get it for that quarter.
Right.
It also depends on the number of employees, correct?
Correct.
Correct.
Yeah.
So if they're under the 100 employees, and in that situation, all the wages would apply for that quarter. If you're over, we're assuming this is a 2020 question, that it would only be those employees that are affected.
Right. That's right.
That's correct.
I believe that's all we have for questions.
Good. Well, I want to thank everyone for attending. Again, if anyone has any questions, feel free to email Charlie, myself, or Greg, or Susan, or anyone, or whoever you work with also, if you're working with our firm currently. So email directly, and we promise to get right back to you as soon as possible.
Correct. Yep. Again, thank you for joining us. A lot going on. It's moving fast, and we're here to assist.
Thank you.